Welcome to the lecture about swaptions and callable swaps. My name is Tim Glauner. Before we begin, please note the information regarding copyright and trademark. Alright, so let's take a look at the outline for this session. We'll start with an introduction to swaptions. We will define what they are, how they work, and their roles in the broader derivatives market. Then we'll move into callable swaps, which introduce an element of early termination that distinguishes them from standard swaps. Next, we'll cover some applications of swaptions and callable swaps, how these instruments are used in practice by financial institutions, corporations, and investors. From there, we'll dive into the technical side, with swaption pricing models exploring different approaches to valuing these instruments, including widely used industry models. That leads us to market data for swaptions, where we'll discuss the key inputs needed for pricing, such as volatility surfaces and yield curves. Then we'll shift into swaption risk measures, looking at how we quantify and manage risks associated with these instruments. Finally, we'll wrap up with swaption operational support, covering the mechanics of executing, managing, and settling these trades. This structure should give us a well-rounded understanding of the topic, balancing theory, pricing methodologies, and real-world applications. We'll begin with an introduction to swaptions, and actually start by reviewing what a vanilla non-callable swap is. An interest rate swap is a financial derivative where two parties agree to exchange cash flows based on different interest rates. The primary types of swaps include fixed for floating swaps, where one party pays a fixed rate and receives a floating rate. Basis swaps involving the exchange of two different floating rates, and cross-currency swaps, which involve swapping cash flows in different currencies with both notionals exchanged at the start and end of the contract. These instruments are extensively utilized for risk management and optimizing portfolio, as well as investment banking. Interest rate swaps have diverse applications. Funding alignment. They often are used to transform all cash flows into floating rate plus a spread cash flows that are aligned to the funding rate of the institution. Hedging. Swaps are effective tools for reducing exposure to fluctuations in interest rates. Point 3, speculation. With minimal capital investment, participants can speculate on future changes in interest rates. And portfolio management. So swaps allow managers to optimize the duration and optimize cash flow profiles of portfolios without needing to purchase assets directly. Let's now move on and start with swaptions. A swaption provides its holder with the right, but not the obligation, to enter into an interest rate swap agreement at some point in the future under predefined terms. Key features include the premium. This is what the dealers charge for granting the swaption and typically paid either upfront or at expiration. The underlying asset. The underlying asset is typically a forward-starting interest rate swap. A strike price, K. This is the agreed-upon fixed rate of the underlying swap. And maturity, T, the final date by which the option must be exercised. At maturity, settlement then may occur via physical delivery, so you have to enter into an actual swap, or through a cash payment based on market values. The payoff structures vary depending on whether it's a payer or a receiver swaption. The conceptual payer-swap payoff is the maximum of the swap rate at time t minus the strike rate, 0. The receiver swaption is the other way around, so the max of the strike rate minus the swap rate at time t, the expiration, and 0. Swaptions can be categorized as either payer or receiver. So a payer swaption gives holders rights to pay fixed and receive floating rates in the future. Receiver swaptions provide rights to receive fixed and pay floating rates. They also come in various option styles. The European style allows exercise only at a single date expiration. Bermudan style, quite common, permits exercise on multiple specific dates or ranges of dates before expiration. American style allows exercising starting at some time in the future and then any day until maturity. Naming conventions reflect their structure. For example, a 3-7 swaption indicates an option expiring in 3 years that enters into a 7-year swap upon exercise. This slide displays an example trade screen for entering a European payer swaption transaction, showing details like the notional amount, 100 million, the term structure, 2 years until option expiration, leading into a 5-year swap, and the strike is set at 3.66467%. Let's go into the details. The end date is March 21st, 2024, and I'm starting in the upper left corner. I'm buying a European option that expires on March 23, 2026, and the trade is settled in cash. On the expiration date in 2026, I will receive a payment if the swaption is in the money, equal to the value of the underlying swap. There are other types of swaptions where settlement is physical, meaning you actually enter into the swap. However, this one is cash settled. The premium is $1.9 million, which I need to pay to JP Morgan. We'll discuss the premium in more detail shortly. The underlying swap starts 2 days after the expiry and lasts for 5 years, ending on March 25, 2031. The notional amount of the swap is $100 million. The pay leg, the underlying of the option, is a payer swap, meaning I pay a fixed rate of 3.66467% while receiving SOFR. Looking at the analytics of the swaption in the 4th column, the deal is valued at $1.878 million. The fee, which represents the net present value of the premium, discounted slightly because it's paid in the future, is $1.909 million. This is slightly higher than the NPV as JP Morgan takes a margin. The delta represents the trade sensitivity to a 1 basis point move up in interest rates. If the yield curve rises by 1 basis point, the deal gains $20,000 in value. The gamma, which measures the change in delta, is expressed as a percentage and scaled by 100, given a numerical value of 146. We'll go into these in more detail later. The vega is 23,500, meaning that if volatility increases by 1 basis point, the trade again gains in value. We can skip over rho and theta for now. On the far right, there are additional analytics to help validate the numbers. The flat volatility is the implied volatility used for this European swaption. Since multiple expirations exist, the flat vol isn't always straightforward to compute, but here it represents the standard implied volatility, approximately 80 basis points. The yield is 3.66%, and the risk-free discount rate at option expiration is also provided. Overall, the swaption screen gives a pretty clear sense of the main items that are required, showing a 2-year and a 5-year European swaption on $100 million. Now, we're moving from a swaption to discussing callable swaps. A callable swap provides the holder with the option to terminate the swap agreement before its maturity. This feature distinguishes it from a swaption, which grants the right to enter into a swap rather than exiting one. Structurally, we can break down a callable swap into 2 components. A callable pay-fixed swap combines a standard pay-fixed swap with a Bermudan receiver swaption. Conversely, a callable receive-fixed swap combines a receive-fixed swap with a Bermudan pay swaption. The rationale is that the Bermudan swaption allows the option holder to enter with no cost into an offsetting swap at some time in the future. This is effectively a termination of the standard swap. In terms of naming conventions for callable swaps, we use the written format tenor of the swap followed by NC and then the non-call period. For instance, 10NC3 refers to a 10-year swap that cannot be called for the first 3 years, but may be called on any subsequent payment date thereafter. This is pronounced and stated as 10 non-call 3. The premium for this optionality is integrated into the coupon rate of the swap itself, rather than being paid separately. It's important to note that while any swap can be technically terminated early, doing so typically incurs significant costs, including both the value loss and additional fees. However, with callable swaps, termination during permissible periods does not incur these extra costs. We can summarize the main difference in this table. A callable swap obligates the parties to enter into an agreement, but allows for early termination under certain conditions. In contrast, swaptions provide high flexibility as they only offer an option to enter into an agreement without any obligation. Typically, users of callable swaps include entities like debt or loan issuers who are looking at hedging against prepayment risks. On the other hand, institutions managing interest rate risk might prefer swaptions due to their flexibility. From a cost perspective, callable swaps often have lower upfront costs since their premiums are embedded in rates rather than being paid out separately, like in the swaption, which require an explicit premium upfront. So callable swaps and swaptions have many similarities, but serve different needs depending on their objectives and risk management strategies. We've now covered the swaption and the callable swap as a product and how they work. Let's look at 3 use cases where they are used. This will be quite interesting. When a company issues callable fixed rate debt, it faces interest rate risk. If rates decline, the company is locked into paying above market rates, while competitors may benefit from lower borrowing costs. Conversely, if rates rise, bond prices typically drop, often below par value. This can undermine investor confidence and potentially lead to credit downgrades and increased future borrowing costs. To manage this risk, companies often engage in hedging strategies. However, typical receiver swaps are not effective for callable debt because if the debt is called or redeemed early, the swap remains active. This creates new exposure to interest rate fluctuations as the original purpose of the swap to offset the now called debt no longer applies. To address this issue effectively, companies might use a callable receiver swap structured with a dealer. In this arrangement, the receive leg of the swap matches the cash flows of the callable fixed rate debt. The pay leg consists of SOFR, Secured Overnight Financing Rate Index, plus a spread. This structure converts fixed rate obligations to floating rates, thereby hedging against the rate changes effectively. Importantly, when the underlying callable debt is redeemed or called by the issuing company, the swap also terminates. Dealers who understand both market dynamics and specific client needs often propose and help structure both elements, the callable receiver swap and its associated callable fixed rate debt issuance. Moving on to use case 2. Banks that invest in mortgage-backed securities, MBS, face significant prepayment risks because homeowners can refinance their mortgages at any time when interest rates fall favorably. This prepayment optionality introduces nonlinear risks, such as volatility and convexity. Linear financial instruments, like standard swaps, do not adequately hedge against this type of risk. To better manage these risks associated with MBS investments, Banks may use swaptions to offset the nonlinearity of interest rate exposure. Swaptions specifically address embedded optionality within mortgage-backed securities by allowing banks to hedge potential losses from prepayments more directly than standard swaps. However, swaptions are generally more expensive than traditional hedges and require periodic rebalancing, since they do not provide a perfect hedge against all exposures. The OIS model's Vega sensitivity matrix helps identify optimal swaption hedges by quantifying how changes in volatility affect different parts of an MBS portfolio, a topic we will explore further later in this lecture series. And lastly, use case 3 about refinancing risk. When a company has fixed rate debt maturing in the future, it faces the challenge of planning for its next issuance. One of the biggest risks in this process is the potential rise in interest rates before the refinancing date. If rates increase, borrowing costs could rise significantly, adding uncertainty to financial planning and potentially raising overall expenses. This uncertainty makes it difficult for companies to forecast future liabilities and maintain financial stability. To mitigate this risk, companies can use interest rate swaps or swaptions to secure a predictable borrowing rate well ahead of refinancing. The two primary tools for this strategy are forward-starting swaps and swaptions. A forward-starting swap allows a company to enter into a payer swap today, but it only takes effect on a future refinancing date. This structure provides a hedge against interest rate movements leading up to that date. If interest rates rise, the swap generates gains that help offset the higher cost of debt refinancing. If rates remain stable, the swap has no financial impact. If rates fall, the swap adds cost, but this is at least partially offset by the benefit of refinancing at lower rates. One key characteristic of a forward-starting swap is that it represents a binding commitment, regardless of market conditions on the refinancing date. The company must honor the agreed swap terms. This makes it an effective hedge, but also requires careful consideration of market expectations before entering the contract. Conversely, an alternative approach to managing refinancing risk is using a European swaption, which offers greater flexibility compared to a forward-starting swap. A European swaption is an option on an underlying interest rate swap that begins on the refinancing date. Instead of a binding obligation, the company pays a premium upfront for the right but not the obligation to enter into the swap at that future date. If interest rates rise, the company exercises the swaption, locking in a fixed borrowing rate and hedging against higher refinancing costs. Once exercised, the swaption effectively becomes the forward-starting swap we discussed in the previous slide. If rates stay flat or fall, the swaption expires worthless, allowing the company to refinance at the new lower rates without any future financial obligation. The structure provides a key advantage. It allows the company to benefit from falling rates while still maintaining protection against rising rates. The only downside is the upfront premium cost, which reflects the value of this flexibility and optionality. Now, let's compare the key differences between a forward-starting swap and a swaption when used for hedging refinancing risk. The most fundamental difference is the obligation to enter the swap. With a forward-starting swap, the company is mandated to enter into the swap when the refinancing date arrives, regardless of market conditions. With a swaption, entry is optional. The company can choose whether to exercise the option or let it expire. In terms of upfront cost, a forward-starting swap has no initial payment, whereas a swaption requires an option premium upfront, reflecting the cost of flexibility. If interest rates rise, both hedges effectively neutralize the impact. The swap locks in a predetermined rate, protecting against higher borrowing costs. However, if rates fall, a forward-starting swap offers no financial benefit as the company is locked into the agreed fixed rate. In contrast, a swaption provides a clear advantage. It simply expires, allowing the company to refinance at the lower market rate. In terms of flexibility, a forward-starting swap is rigid. Once signed, there's no exit option. The swaption, on the other hand, provides maximum flexibility. The company only exercises if it's beneficial. Finally, from a cost perspective, a forward-starting swap has a lower overall cost structure as there is no upfront premium. A swaption, while offering more flexibility, is more expensive due to the premium paid for the optionality. The next three sections, section 4, 5, and 6, will be quantitative topics about pricing, required market data to price swaptions, and how risk sensitivities are calculated. We will start with the pricing models that are used in the market. The pricing of European swaptions relies on well-established closed-form models, meaning that we can compute prices using specific mathematical formulas without requiring complex numerical simulations. There are two main mathematical models, the Black model and the Bachelier model, which differs in their assumptions about interest rate behavior. The Black-Scholes model, also called the Black model, widely used between 1990 and 2008, assumes that swap rates follow a log normal distribution, with the assumption that rates can only be positive. It was historically the dominant pricing framework and requires log normal volatilities and volatility smiles as inputs. The second model is the Bachelier model that assumes that swap rates follow a normal distribution. This approach has become more popular in recent years, particularly in low or negative interest rate environments, where the log normal assumption of the Black model becomes impractical. The choice between these models depends on market conditions, with Bachelier now being the preferred standard in many cases due to the reality of negative or near zero rates. In fact, now in 2025, with rates far above zero, Bachelier is still the standard model, and the market has not moved back to the Black model. The key inputs for these closed-form swaption pricing models include market data such as interest rate curves, volatilities, and volatility smiles that reflect market-implied prices. Let's discuss the pricing of Bermudan swaptions. These swaptions are significantly more complex than their European counterparts, as they allow for multiple exercise dates rather than a single expiration. Some consider them exotic derivatives due to the nuanced challenges involved in pricing and risk management. There are two primary ways to view this product. One view is that the European swaption with an embedded additional option to extend. This means its value consists of the standard European swaption plus the additional value from the option to extend. The second view is that it's a single package of multiple options, each option with a probability that it gets exercised. Its value falls somewhere between the probability-weighted sum of multiple European swaptions and an American swaption which allows exercise at any time. The key challenge in pricing Bermudan swaptions is determining the optimal exercise strategy, deciding when to exercise for maximum value. Since the value of this early exercise feature depends on complex interactions of interest rate curve movements and the behavior and shape of the volatility surface, more advanced numerical pricing models are required. Models like Hull&White and BGM are commonly used for pricing, calculating Greeks, and managing risk. Part of using these models is calibrating model parameters to liquid market instruments, ensuring the model reflects current market conditions and accurately captures the dynamics of interest rates and volatility. One standard method for pricing Bermudan swaptions is the recombining trinomial tree, which efficiently models interest rates and prices the early exercise option well. We will now cover in some detail the Hull-and-White pricing model. Bermudan swaptions are typically priced using numerical methods rather than closed-form formulas due to the need to value the complex optionality. There are two main pricing techniques. One, and by far the more popular one, is the trinomial tree. It numerically prices the trade and the tree simulates the interest rate behavior. The second one, and less common, is the Monte Carlo simulation. It estimates the Bermudan swaption values by simulating numerous potential rate paths and has special logic for determining the optimal exercise strategy. One of the most widely used models for pricing Bermudan swaptions is the Hull-and-White model. The model is a stochastic interest rate model designed to reflect market behavior by incorporating several key features. Mean reversion of short-term rates, meaning that interest rates tend to revert toward a long-term equilibrium level rather than drifting indefinitely. Consistency with the initial term structure, ensuring that the model aligns with observed market interest rates at the outset. Time-dependent volatility, allowing the model to better capture fluctuations in market conditions over different periods. To ensure the model reflects the markets, the Hull-and-White model is calibrated to current yield curves and European swaption prices. The Hull-and-White model describes short rate dynamics using a stochastic differential equation that governs the evolution of interest rates over time. The equation is dr, which is the change in the short rate, equals theta t minus a of t times rt times dt. This is the deterministic term, plus the short rate volatility sigma t times dw. Here the drift term theta t is calibrated to the initial yield curve, ensuring that the model aligns with observed market conditions. The parameter at controls mean reversion, which can be either a constant or time-dependent function. This determines how quickly the short rate reverts to a long-term average over time. The term sigma t represents time-dependent volatility, allowing the model to capture fluctuations and in interest rate movements. The final component, dw, is a Wiener process modeling the random nature of rate changes over time. The trinomial tree is a common numerical approach for discretizing the short rate in the Hull-and-White model. It structures the evolution of interest rates by allowing three possible movements at each time step. Up movement, where the short rate increases. Down movement, where the short rate decreases. And a no volatility movement, where the rate follows its drift component without additional randomness. Each of these movements occur in a specific probability, ensuring that the model remains arbitrage-free and consistent with market conditions. This method is particularly useful for efficient derivatives pricing, as it models interest rate paths while maintaining a tractable analytical structure. Additionally, it allows for flexible calibration to market data, making it a popular choice in practice. An alternative approach is the Monte Carlo simulation, which requires an early exercise decision model to determine optimal exercise among the options. While we won't cover it in detail here, one notable example is the Longstaff and Schwartz model, which is used in Monte Carlo-based pricing of Bermudan-style derivatives. When you have time, it's worthwhile to research it. Let us first look at the left side. In the recombining trinomial tree, the short rate evolves through a structured set of possible movements at each time step. We start with the initial rate R0, which branches into three possible states at the first step. an upward movement in the short rate with probability PU1, a middle movement where the rate follows its drift with no additional volatility with probability PM1, and a downward movement where the rate decreases with probability PD1. At the second step, each of the states further branches out. The rate moves up twice consecutively. The rate moves up first, then follows the middle path. The rate follows two middle paths sequentially. The rate moves down first, then follows the middle path, and the rate moves down twice consecutively. This branching structure continues over multiple time steps, allowing for a recombining framework. You can see the recombination at node R0, M1, M2, which can be reached three different ways. Let's recap one more time with the comments on the right. The trinomial tree begins with an initial short rate R0, representing the starting value for interest rate evolution. A key feature of this model is that the tree recombines, meaning that different paths leading to the same rate at future time steps. Specifically, an upward movement followed by a downward movement will land on the same node as a downward movement followed by an upward movement. The structure reduces the number of unique rate paths, improving computational efficiency. To ensure no arbitrage, the model enforces specific rules for rate movements and their associated probabilities. At each time step, the short rate can transition to one of three possible states: an upward movement U with probability PU, a middle movement M where volatility has no effect with probability PM, and a downward movement D with probability PD. By structuring rate evolution in this way, the tree provides a complete representation of potential interest rate movements over time. Future rate values and their associated probabilities are systematically computed using this framework, making it an excellent tool for pricing derivatives and managing interest rate risk. We'll now go through the algorithm of pricing a Bermudan swaption on such a tree. The first step is to load the interest rate curves and the normal swaption volatilities and volatility smiles from market data. These inputs define the starting condition for rate evolution and option pricing. Next, we either set a single mean reversion parameter A manually or derive it from market data using a model. Mean reversion determines how quickly short rates move back toward the long-term average. We then calibrate the drift term theta t and volatility sigma t to ensure consistency with market observed prices. This calibration process is essential for aligning the Hull-and-White model with interest rate behavior. With these parameters set, we construct the Hull-and-White recombining trinomial tree, which models the evolution of interest rates over time. At the final time step, capital T, we price the underlying swap at each node in the tree. This serves as the foundation for valuing the Bermudan swaption through backward induction. In step 6, we apply backward induction through the trinomial tree. Start at the final step, capital T, and move back to T-1. At each node on T-1, calculate the extension value by discounting the probability-weighted values from nodes at time T to time T-1. Compute the intrinsic value of the underlying swap at T-1, assuming exercise. Then, at step 9, determine the node value by taking the higher of the extension value and the intrinsic value. This represents the optimal exercise decision. Now proceed with backward induction through the tree. Recursively move from T-1 back through T-2, T-3, and so on, computing extension and intrinsic values and applying the exercise decision at each step. Once this process reaches the first node, the final computed value represents the Bermudan swaption price. Let me point out that the tree contains a wealth of analytical insights. While we won't dive into every detail here, are some key takeaways. First, a tree provides a complete set of probabilities for when the Bermudan option is optimal to exercise. Since each node explicitly indicates whether the option is exercised or not, you can determine the likelihood of early exercise at every step. Additionally, the tree can be used to derive Greeks, including theta, the time decay of the trade. As the tree progresses forward in time, you can observe how the option values evolve across different nodes. Similarly, you can track delta, which quantifies how the option's value responds to changes in interest rates. By analyzing the movement of rates and corresponding value shifts within the tree, you gain direct insight into delta's behavior. In short, the tree provides a rich source of analytical information, offering multiple perspectives on option pricing, risk management, and sensitivity analysis. Now that you have seen conceptually how to use a tree for pricing, we need to discuss how to get all the parameters to build the tree. These Hull and White model parameters are not directly observable, so they must be determined through calibration. The key tree parameters include mean reversion AT, which can be a single fixed value or time-dependent. Time-dependent drift theta t, which adjusts to fit the yield curve. Time-dependent normal volatility sigma t, which captures interest rate fluctuations. Calibration is essential to ensure the model accurately reflects market conditions. The process depends on the specific trade and selected calibration instruments. In general, parameters are set so that the model reprices the calibration instruments to match market prices. Calibration is done in steps. Mean reversion AT is calibrated first, independently of theta t and sigma t. Drift theta t and volatility sigma t are then calculated to ensure the model aligns with observed market data. As this is an introduction into swaptions, we are not going into numerical details in how to calibrate to a set of European swaptions, but leave this for a more advanced course in the future. In general, and not really related to Bermudan swaptions, calibration of the Hull and White model presents two key challenges. One is selecting appropriate instruments for calibration, especially for complex structures. The other one is numerically adjusting model parameters to ensure the selected instruments are repriced correctly. For Bermudan swaptions, the standard approach is to calibrate using European swaptions. Specifically, calibration often focuses on the diagonal of the at-the-money volatility matrix, which represents swaption volatilities for maturities that match the underlying swap tenors. Remember, for option prices and volatilities, they are equivalent. European swaptions are commonly used for calibrating as they provide observable market prices with clearly defined strikes and underlying swap maturities. The key calibration principle is to select calibration instruments that align with the Bermudan swaptions exercise dates and swap maturities. For example, consider a 2 into 5 year Bermudan swaption in USD. The standard calibration instruments would include a 2 into 5 European swaption, which directly matches the Bermudan structure as it's the first option expiration date, a 4 into 3 European swaption, and 5 into 2 year European swaption, covering different option expirations and the corresponding swap maturities you would exercise into. We do not include the 3-year into 4-year European swaption, as we would need to interpolate, and that point is likely not very liquid. Remember, we need to price trades every day, and reliable market data is very important to avoid noise in the daily valuations. A 6-year into 1-year European swaption is the last point we use. For advanced pricing, the calibration can also incorporate volatility smile effects, as the strike of the Bermudan swaption does not equal the at-the-money rate of the European swaptions. This table highlights key calibration instruments used for a 2 into 5 Bermudan swaption, focusing on the at-the-money swaption volatilities. As before, the vertical is the time to expiry, and the horizontal are the swap tenors. The calibration process relies on specific volatility to ensure that the model reprices the most relevant European swaptions consistently. These volatilities represent the market consensus of the price of the relevant European swaptions. The diagonal values are indicated in blue, where expiry and tenor match Bermudan exercise dates, and that are particularly important. The blue oval also shows why it's called the diagonal. You can see the European swaptions that are used is the 6 into 1, 5 into 2, 4 into 3, and 2 into 5. Let us now talk about the market data needed to price swaptions, be it callable swaps or European and Bermudan swaptions. Note that this market data will apply to all 3 models, the Black, the Bachelier, and the Hull and White model. First, we need one or multiple yield curves. Usually one per trade is fine, as floating rate index and discount index are often the same. The yield curve is used for several purposes. One is for pricing the underlying swap. The yield curve is used to project floating rates and discount cash flows. 2, computing the break-even swap rate. This involves calculating the specific swap rates of the calibration instruments at which the present value of fixed leg payments equals that of floating leg payments. The smile adjustment is based on this rate and the strike. 3, the yield curve is input into calibration of the drift, as the Hull and White model needs to be able to replicate the no volatility discount factors. 4, the model formula requires the discount factor to option expiration. And lastly, the option premium that is paid to the dealer needs to be discounted to today for P&L purposes. Sometimes this premium is paid at the option expiration, which is possibly a few years away. On your right is a graphical representation showing an example of a SOFR curve. The first point is the overnight SOFR rate. Then we use standard OAS SOFR swaps, where one leg pays annually the fixed rate, and the other leg pays annually the daily compounded SOFR rate. From such a curve, you build the zero curve, which is then used in the models. Now, we see the quoted at the money normal volatility matrix for European swaptions. In this matrix, the option expiration is on the vertical against the swap tenors horizontally. For instance, the highlighted number represents the 79.93 basis points prices a 2 into 5 year swaption at market when using the Bachelier model, where the strike is exactly the same as the forward swap rate. We now move to the swaption smiles, specifically related to 1 year underlying swaps. It's not uncommon for the surface to be referred as skew. While skew and smile are formally distinct but related phenomena, the terms are often used interchangeably when precise terminology is not essential. Smile basically defines a volatility adjustment when the trade is not at the money. In this matrix, the vertical axis represents option expirations, while the horizontal axis indicates moneyness, expressed in percentage terms to show how far options are in or out of the money. The highlighted cell shows a minus 4.49 basis point volatility adjustment for the option expiration of 2 years and 1% out of the money. Let me also remind you that this is for the 1-year swap underlying, so the adjustment to the first column in the previous matrix. This table represents the swaption smile for a 2-year swap underlying. It's a similar matrix as in the previous slide, but for the 2-year underlying, which is the second column in the at the money matrix. Similar matrices exist for all swap tenors, capturing volatility dynamics across different maturities. To maintain consistency in these smiles, the market relies on put-call parity, which helps reduce the number of required smile matrices, while ensuring arbitrage-free pricing relationships. We have covered market data inputs into the model, the yield curve, the at-the-money volatility matrix, and the smile adjustment. We now move on and discuss how risk measures for swaptions can be calculated. Risk measures can be calculated through two main approaches. Closed-form Greeks, which involve differentiating the pricing formula directly and therefore having a new formula for each type of Greek measures. And practical Greeks, which are derived by pricing the trade, then shifting inputs and repricing. The change in price is then the sensitivity. This method to calculate practical Greeks is also called a finite difference approximation in mathematics, physics, or engineering. Let's first focus on the Bachelier valuation formula for a swaption. It's a complicated formula and goes beyond the course to interpret the different components of the formula. I'll give you a few seconds to look at it though. We should discuss the inputs though. S represents the forward swap rate and K is the strike rate with a fixed coupon. D0T is the discount factor to time T and sigma is the normal volatility of the swap rate. The term capital T indicates time to expiry. I'll skip over D as it's just a constant. It's not important to interpret it. I do want to point out the standard normal cumulative distribution function n of x, which we'll discuss further in the next slide. I suggest you take the entire Bachelier formula as a given, but let us talk more about the normal cumulative distribution function. So n of x represents the probability that a standard normal variable is less than or equal to x. The integrand here is essentially the probability density function of a standard normal distribution. It's an integral from -infinity to x. For pricing purposes, it estimates the likelihood that the swap rate will surpass the strike, assuming a normal distribution of the swap rate. We have differentiated the Bachelier formula in respect to several variables to illustrate the formulas to calculate closed-form Greeks. Delta measures how sensitive the swaption price is to changes in the underlying swap rate. Differentiating the valuation formula with respect to S gives us D0T times the normal distribution function to D. D was defined two slides earlier. Gamma represents the second order sensitivity to changes in the swap rate, capturing convexity effects. Differentiating the valuation formula twice with respect to S results in a more complex looking function, but it's still straightforward to compute. Vega quantifies sensitivity to implied volatility changes. A useful interpretation that this Vega is the price change when shifting the whole at the money volatility surface by 1 basis point. D0T represents the discount factor, which is computed using Z at maturity, the continuously compounded zero rate. These closed-form derivatives allow us to efficiently calculate how prices change with movements in underlying variables. requiring just a single formula evaluation for each Greek sensitivity. For practical illustration, let us go back to our Swaptions screen. The blue box lists the closed form Greeks for our at-the-money 100 million 2-5-year European payer swaption. The forward swap rate for a SOFR versus fixed rate on March 21st, 2024 was 3.66467%, which equals the strike of the trade. Delta is around $20,000, which means that when rates go up by 1 basis point, that the value of the trade increases by about 20,000. Convexity is 14,666, but note that it's shown in percent, so scaled by 100. The actual numerical gamma number is therefore 147, which means that when rates move by 1 basis point, delta changes by 147. Now, Vega for a normal model represents a shift of volatility by 1 basis point, and the amount for this trade is about 23,500. We'll skip over rho and theta. Practical Greeks are derived by systematically shifting market data points, such as interest rates or volatilities, and recalculating trade values to measure the impact of those changes. Typical shifts involve adjusting parallel curves or individual points by small increments, such as 1 basis point for rates or normal volatilities. This approach ensures consistency across different models and trade types. Since various trades rely on different models, shifting market data provides a uniform methodology, whereas summing closed-form derivatives across different models and formulas can be less reliable. Additionally, practical Greeks allow for a flexible application of similar methodologies to various types of market data, including smile and skew effects. Now let's walk through the perturbative hedge algorithm. It's a numerical approach for calculating practical delta. This method works by systematically shifting individual points on the curve and measuring how these changes affect the trade's valuation. The process follows these steps. Build the zero curve and price the trade at its initial state. Then record the base value V0. Shift the first rate point R1 by 1 basis point. Now rebuild the zero curve and reprice the trade, recording the new value V1. Set R1 back to the original value and shift the next point R2 by 1 basis point. Build the curve, revalue the trade, and record the new value V2. Repeat the process for each point Ri along the curve, calculating the corresponding Vi values. Now you can compute the sensitivity at each point using delta I equals to Vi minus V0, which is the base value. The table to the right summarizes the delta of each rate point, showing how the trade's value responds to changes in different maturities. The total delta is about 19,883, representing the trade's overall sensitivity to rate shifts. Now, an interesting observation from the sensitivities circled in blue is that you can see how the 2-5 swaption is related to a forward starting swap. You have 7-year exposure, that's positive, and then you have negative exposure on the 2-year point. So that shows that you effectively have bought the 7-year and sold the 2-year. So effectively have an option on a 2-year forward starting 5-year swap. This type of rate sensitivity analysis on the swap points is also referred to as key rate durations, where each swap rate is analyzed for its localized impact on the trade's value. Now, Vega measures sensitivity to volatility changes, showing how the trade's value responds to shifts in implied volatility. The calculation follows the same perturbative approach used for delta, but instead of shifting interest rates, we adjust volatility points in the volatility matrix. Log normal volatility is typically shifted by 1% or 100 basis points. Normal volatility is shifted by 1 basis point. The matrix displays Vega values across different expiries and tenors, representing how much the trade value changes when volatility increases at each point. The total Vega is computed by summing individual contributions across all points in the matrix. This shows the result of the single trade, but you can imagine that for a large options portfolio, this matrix can get very complex. The exposures also change over time and change when rates or the shape of the curve move significantly. This risk output is essential for managing volatility exposure, particularly in options and derivatives trading, where changes in implied volatility can significantly impact the daily profit and loss of an existing portfolio. We are finishing this section by comparing the closed form and the practical Greeks, highlighting their advantages and the trade-offs. A drawback of closed form solutions is that not all formulas are analytically differentiable, meaning that some models do not allow for exact mathematical differentiation. A drawback of practical sensitivities is that it can introduce noise due to numerical approximations, especially in complex models. However, in many cases, the results between closed form and practical Greeks tend to align closely. Closed form Greeks are efficient and computationally cost-effective, making them ideal for quick calculations. In portfolio analysis and risk management, practical sensitivities are often preferred because they work across all models, including those without closed form solutions. The table compares for our trade the delta and Vega computed using both methods. For delta, the closed form calculation gives $20,080, while the practical shift-based method gives $19,883, a close match. For Vega, both methods result in exactly $23,503, showing no difference in this case. Let's now discuss in our last section the required operational support for swaptions. Managing swaptions post-trade requires robust operational support to ensure accurate processing, risk management, and compliance. Key post-trade requirements include accurate trade capture and confirmation to ensure that trade details are correctly recorded and agreed upon. Handling premium payments and swap settlements, ensuring timely and accurate financial transactions. Valuation using market-aligned models to maintain consistency in pricing and P&L calculation. P&L attribution to break down gains and losses due to market movements and time decay effects. Lifecycle management, including monitoring expiry dates and deciding on cash or physical settlement of the swaption. Bermudan exercise strategy, which involves complex decision-making as exercise opportunities arise multiple times before expiry. This is done often by the front office, as the decision needs to be done by traders or desk quants. Effective collateral management, ensuring appropriate margining and risk mitigation. Compliance with GAAP and hedge accounting standards, ensuring financial reporting aligns with accounting principles. Regulatory reporting under EMIR and Dodd-Frank, meeting global trade transparency and risk management requirements. Each of these elements ensures smooth post-trade processing and the ability for the front office that is revenue generating to scale the business without incurring significant operational risk or time-consuming reconciliations. This brings us to the end of this lecture. We've covered a very broad range of topics on swaptions and callable swaps, from their fundamental mechanics to their practical applications, pricing methodology, risk management, and operational considerations. Let's take a moment to recap what we discussed. We began with an introduction to swaptions, breaking down their structure, types, and role in interest rate markets. We then moved on to callable swaps, highlighting their embedded optionality and how they relate to swaptions. From there, we explored the applications of swaptions and callable swaps, examining their use in hedging strategies and managing convexity and vega risk for an MBS portfolio. Next, we divided into swaption pricing models, looking at key frameworks like Black, Bachelier, and Hull and White, and discussing calibration techniques. We then covered market data for swaption pricing, including yield curves, volatility surfaces, and the impact of smile effects. We followed that with an analysis of swaption risk measures, focusing on key sensitivities such as delta, gamma, and vega, and how they contribute to risk management. Finally, we touched on swaption operational support, emphasizing the importance of trade capture, valuation, lifecycle management, and regulatory compliance. Within these topics covered, you now have a solid foundation in understanding how swaptions function, how they are priced, and how their risks are managed. Moving forward, you can build on this knowledge with deeper dives into specific models and market applications. Thank you so much for attending the lecture. If you have any questions or comments, please do not hesitate to reach out via the comments or email. I'm looking forward to seeing you in the next session.